Hello, everyone. Today on the Final Bar, my guest is Dave Landry from DaveLandry.com. Always does a great job bringing some charts that make me think. We're going to talk about lumber prices and some of the ripple effects of changes in that part of the market. The S&P overall essentially flat. This is a digestion day, sort of a choppy day, processing previous gains up and down through the course of the day, but really settling into the zero level with most other equity-related asset classes and mineral commodities continuing to rise, though. Ladies and gentlemen, this is the Final Bar. Hello, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down these markets using the charts, focusing on the message that the markets provide and the value of understanding price as a reflection of the collective investor psychology. If you want to understand what investors are thinking, you want to see when they are excited, desperate, panicked, optimistic, pessimistic, I would argue price can tell you all of those things and more. It's all about having a consistent toolkit for analyzing price data. Now, today we talked about the S&P being flat, plenty of movements though, and it was the meme stocks, the Reddit stocks jumping up again, double digits, even triple digits at one point for AMC, but pretty much that whole basket, Bed Bath & Beyond, AMC, a bunch of other ones, and sort of that group all jumping up pretty significantly today. And, it's interesting. I was asked by a media outlet earlier to comment on it. And, to summarize what I shared with them, these sorts of moves are certainly unexpected, but possible. I'm less concerned by the excitement of the unbelievable one-day gains you can have. I'm more concerned with your ability to manage the risk when it goes back down. As much as AMC has been a fantastic stock today, remember, after running into January, it was down 70% pretty soon after, and that's the challenge. We have some great guests along the way helping us to understand the market activity, by the way. Dave Landry, excited to have him back on the show a little bit today. Tomorrow, we have Craig Johnson from Piper Sandler joining us from Minneapolis. Next week, on Tuesday, we have Jesse Felder from the Felder Report. And then on Wednesday, Javed Mirza from Canaccord Genuity in Toronto. Probably still struggling after the Toronto Blue Leafs just opted out of the playoffs in a most painful way. But let's move on from that. We'll get to the market recap. As I mentioned, if you look at the broad market, you see flat returns. But if you dig a little bit deeper and look at some of the movements, you'll see that there's plenty of activity to make sense of. Energy really led the way higher today. In the commodity space, we've talked about the strength in commodities. I know when I was recording my monthly chart review for my premium members earlier today, we focused a little bit on the commodity space, looking at DBC and CRB and GCC, the different commodity ETFs, but focusing also on crude oil versus precious metals. And overall, my way of summarizing that space is fairly constructive. And it goes from very constructive. If you look at the chart of the DBC, it's just a nice, consistent uptrend. Something like gold has really more emerged coming out of a transition from a downtrend to an uptrend. But overall, I see a lot to like in that space. And I'm not surprised to see energy moving higher. I think a lot of people are surprised to see real estate consistently at the top or near the top of the list. Once again, today, up 1 1/3%. I think that's a great reminder. Don't think about what should work and then focus your investing, prowess around those ideas. Look at what actually is working. If you ignore the companies and ignore what you think of stocks fundamentally, just look at the chart of REITs and see how they're appreciating. That should be enough to draw you into the space and learn more about why these companies may be doing better than you might expect in an up market. Technology number 3 today, and a little later in today's show, we're going to do a deep dive on the technology sector, hit on some of the groups that are doing well and some of the ones that are struggling within that sector. I mentioned the S&P flat, mid caps and small caps both down, but mid caps really were the worst of the bunch, down 0.6%. The VIX is back just below 1750. Other asset classes very quickly, 10-year yields back below 160 to around 159. and bond prices obviously higher. The dollar literally flattened. I think that downtrend in the dollar, when I was looking at all the major asset classes earlier today, only two asset classes, among many sort of major ETFs that I would look at, only two were in established downtrends. One was the US dollar using the UUP or the dollar index, and the other one, bonds, right? Bond prices, the TLT or the AGG. And again, they're not horribly in downtrends. They're just certainly not going up when most things are. Looking at commodities, the DBC, our main commodity ETF, we follow up about 0.5%, about the same for gold. Silver was up a little more. And some of the commodities were down actually today, but crude oil price is higher, and that's what's helping energy go back up. With cryptocurrencies, again, it's feast or famine. We're back to a positive day with most of the major coins that we follow up just under 5%, 3 to 5% on average, but overall fairly constructive. Now, again, the challenge with these is they're coming off of very volatile swings. And just yesterday, we were dipping below 36,000 on Bitcoin. It's now back to 38,000. So plenty of volatility still to be had in that space, I think, for the foreseeable future. Let's look at a chart of the S&P 500. Not a lot has changed in the last week. When you think of last week with the holiday week, today's the shortened week, but really the week leading up to the holiday is when you tend to have lighter volume, flat to positive returns. That's exactly what we got last week. What have we learned differently this week? Not much. We've had 2 trading days. We're sort of still in the exact same range where we're on Friday with our lighter volume. So I think we are just continuing to confirm the importance of the resistance level we're at between 4,200 and 4,250. If you did not believe that was a significant level, I think you should believe it by now, just with the consistent stalling that we've done right around that same point. Last time we were up at these levels here in late April, early May. That resolved lower, and we actually had a 4.5% loss. The 50-day moving average and trendline support is actually less than that now because we've come off a little bit. It's probably about 3% below current levels where we're at. So given any pullback, that's the first levels I would be looking at. I think you have levels support around 4120, 4130. That would be trendline support, and the 50-day moving average just below there, 4050 is really the line in the sand. That was the pullback in the most recent sell-off. As long as those lows keep getting higher, as we saw here in January and in March, and then again in April, that's what a constructive pattern looks like. What's interesting now is we undercut the previous low. The question is, can we get to a new high right now? And I think the jury's still out on whether or not that's the case here. So overall, the trend in stocks has been positive. Our market trend model that we talked about on Friday's show, overall constructive. The medium-term model, as you may have seen, turned negative, and that's based on the overall trend characteristics. It's interesting when you look at some of the risk on versus risk off measures. They're not crazy positive. Give me just a second here. I'm going to show you one of the charts that I was looking at with my subscribers earlier today. We go to the monthly chart review, and there's this one called risk on, risk off. This is one of the charts that we looked at. And again, this basically summarizes a lot of the charts that we look at on this show pretty regularly, but it's things like equal weighted consumer discretionary versus consumer staples, offense versus defense. It's looking at the relative strength of semiconductors, small caps versus large caps, using the Russell 2000 versus the S&P 500, and then equal weighted S&P versus cap weighted S&P. So, out of the 4 of these, then it's just the S&P, price at the top. Out of the 4 of these, the only one that looks constructive, in that it's in an uptrend and recently made new highs, is the equal weight versus the cap weighted S&P. That's the one that's been a nice consistent uptrend. The rest of these are sort of flat to down. Consumer sectors, if you look at the consumer space, it's been flat. It's basically been saying it's not offense or defense. It's sort of, they're in line, right? They're sort of moving together, and both of them actually sort of flat to down recently. Semiconductors have been underperforming since February. They made a relative high in February, and since then we've had lower highs and lower lows. The Russell 2000 peaked on a relative basis versus the S&P in March, and since then it's been going down. So when I see my market trend model saying the medium term is negative, this is the chart that comes to mind for me. It's not that things are breaking down. It's not that you see a lot of stocks violating support, which I think on average, you see a lot of stocks in pretty decent trends still. It's the fact that these risk off measures or risk on, risk off measures are leaning more flat down. They're not going higher. Now, again, some of them are. It's sort of mixed messages right now, but that's why the medium term model being negative doesn't surprise me a ton, given the action that you've seen in some of these. I mentioned AMC, and when you ask for a technical perspective on a stock that's doubling in one trading day and going over 100% up, it's hard to make sense of that from a technical perspective. But here's how I would do it. A couple things you have to look at something that's gone vertical. Number one, you have to remember that when something is going vertical in price, and the last time it really accelerated to this degree was at the end of January when these names gapped high, and this is GameStop and others obviously that did it. Remember, soon after that, you had a 74% drawdown from the peak down to where we topped, bottomed out just around $6 a share. So if you want to ride this from $2 up to $20, that's fantastic. And that's a really good run. It's just you have to be prepared that at any day, that could be the top close. And from there, if you bought on that high day, it took you 3 months to recover it with a 74% drawdown in the middle. So these sort of moves are great if you're right on that left side of it. If you miss that initial thrust, though, the challenge is, when do you feel like it's a good entry point to get into? So, for me, I think looking at a stock like this, I would avoid looking at some of these, to be completely honest with you, because I see them as pure speculation. It's not really driven on anything other than the influx of speculators and the outflux of speculators. So I would say is, if you are buying something like this, preparing for the upside, you have to prepare for the volatility of the downside. It's the same challenge that you see with cryptocurrencies, of course, as well. Now, the good thing I think you do want to remember is focus on key levels, and on something that's accelerating like this. If I would be nibbling at this, which I'm absolutely not, I would be looking at things like the hourly chart, the 5-minute chart, because these things are moving so quickly. A daily chart isn't really giving you clear lines in the sand. And the only support I see is back below $10 a share, which isn't going to help you very much if we're up at 62. So I would be looking at shorter term timeframes if you're going to speculate on the short term. We need to take a quick break. We'll be back with my guest, Dave Landry. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is your Dave. This is your host,
the Dave
Keller,
Show,
Chief Market Strategist at StockCharts. I was talking with Dave Landry. I have Dave on the mind. I can't get away from it. We'll be with Dave Landry here in a second. As a reminder, we'll do another mailbag segment on Friday's show. We'd love to answer one of your questions on the air. Shoot us an email with any questions that are coming up in your own process. Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. And you can also look us up on YouTube. Just put a comment below the video that you're watching, and we'll capture all those. Hope to answer one of your questions on Friday's show. Also, as a reminder, go to StockChartsTV.com, use your email, set up a free account. You can watch all of our fantastic content, shows like The Final Bar, great guests like Dave Landry and many others featured on our website. Also on demand on all of the app stores. Just search for StockCharts TV on demand. Want to welcome on my guest, Dave Landry. Dave's the founder of DaveLandry.com. Dave always brings charts that make me think, and for that, I'm super thankful. Dave, welcome back.
Hey, glad to be here, Dave.
The Dave Show indeed today, and I appreciate you coming back on. So we're going to start with Homebuilders. Homebuilders are interesting. It's a group that actually was just pounding away, making new highs earlier in the year, and then pulling back a little bit. What is your work telling you about this key group?
I think they're losing some steam, and you brought up the real estate earlier, which I thought was interesting. And I kind of had the same surprised reaction that you did. It's kind of like real estate's making new highs. It's like hard to believe, but as I often say, believe in what you see and not in what you believe, and don't confuse the issue with facts. But the home builders look like they're topping out in here. This is what I would call a pioneer setup. It's a first thrust setup where you have the first thrust from highs, and you have that little bit of a retrace afterwards. And in the bottom chart, this is from the ACP plugin. The green means the lows are greater than the moving average, not the magnitude, just the number of days the lows are greater than the moving average. And you can see we saw a little green, a little red in there, but just looking back to the chart, you can see the home builders have gone sideways for a while. And I think they've topped out. I'm recommending some home builder shorts. Pulte, I think I got short today, and I'm looking at a couple of other home builders as possible shorts. You're not going to get rich on the short side, but I think it's important as a trader to play both sides of the market. So you can see it helps you to see, if it's going up or down. My friends, and a lot of the same people who run a lot of money on the long side only, they're not, not to take anything away from them, because many of them have done very well, as you know, but they always see the glass as kind of half full. And I think learning how to short helps you to see both sides of the market. And I think this is a market that looks like it is topped out, but it could go right back up, but I'm willing to short it and put a stop in just in case I'm wrong.
Interesting chart, and what a change of character for that group. Now, chart number 2 is sort of in that similar theme, looking at the wood ETF. And again, we've talked about lumber prices recently on the show, which with an incredible run higher and then sort of coming back to earth. Talk us through this chart.
Yeah, it's like recently we got a home project here. We're going to build an outdoor kitchen, and the lumber guy said lumber price is going to go up forever. And I thought to myself, like in Caddyshack, no, they don't, Danny. And I've been watching lumber carefully, and September lumber's kind of rolled over. Looks a little bit like this chart. And at the least, you can see that it's lost momentum. If you don't know anything about technical analysis, just look at where the price is and look back a month, a week, or several weeks, or several months, and see if it's made any progress. And it really hasn't. And it looks like it's breaking down a little bit. And we're starting to see a little red in the bottom of the chart, meaning that the lows are below the 30-day EMA, which right now is one of my favorite ETAs for now. EMAs, not ETA.
It's interesting, and again, what a rollover. And to clarify, the LandryLight's really showing the space between the price and the moving average. So the absence of any indicator, there's just showing you that we're really right around the moving average, right?
No, it's well, almost. It's a number of days that the high is below the moving average. Yeah. So looking way off to the left side, and if you find a broker to let you trade on the left side, let me know. You could see that many days, even though it closes in the moving average, it's not like an MACD or something like that. It's just magnitude. But you can look at a glance and see, okay, if this thing's at 50 or 60 or 70, 80, whatever the case may be, that trend is very mature. It doesn't mean that you can't still trade it, but you're probably due for a correction. But once you start seeing a little bit of red, especially after a lot of green, it's possible that the trend has turned.
Very, very good. Final chart, we're going to get into the SPAC space, or these SPACs, as you suggested we call them. Talk us through GHVI. This is probably a name that some people are not familiar with.
Yeah, this is an IPO popped up a few days ago, and I am long the stock, full disclosure. And you could see that there was some initial excitement for it, and then it just died out. And it's a pattern I call a fly, a die, and then a fly again with these IPOs. Sometimes they'll pan out like this. But what we have here is the bow tie moving averages. And when the 30 exponential is above the 20 exponential, and the 20 exponential is above the 10 simple, it's green, and just the opposite is red. And nothing magical about that. But as you can see from the red down below, if you stay mostly short or out of a market while these bow tie moving averages are in proper order, then you'll stay out of trouble, or you'll stay short the market for the downtrend. And when they flip over fairly quickly, it gives the appearance of a bow tie, and that's when the moving averages come together and spread out quickly. And the only thing I look for after that is a 1-bar pullback. In this particular case, we had 2-bar pullbacks, and it triggered today. And so far not so good, but I still think this has longer term potential. So I wanted to show something to the upside. I don't want to seem like I'm just a bear, but that one little area, the home builders and wood and lumber, look like they're kind of topping out in here. I know a lot of people are watching that carefully, and I know price of new houses in some cases locally have gone up 30% recently. So I think that's beginning to roll over a little bit, and I think they'll get a little bit of reprieve. But I think there's some new excitement in the IPOs and some of these SPACs, or SPACs as you call them. I think SPAC is probably correct terminology anyway. But anyway, I like this stock. I think it's bottomed out. And sometimes these IPOs come public, they get a little ahead of themselves. They bottom out for a while, they get their act together, and then they take off once again.
Great take. Appreciate it so much, Dave. And thanks for walking us through the LandryLight and illustrating some of these longer term trends that have begun to turn. Dave Landry from DaveLandry.com. Be well, stay safe. We'll talk to you again soon.
You too. Thanks again. Thanks for having me.
That's Dave Landry. Dave's the founder of DaveLandry.com. And again, his indicator we were using for a couple of those charts is from our ACP platform. That's all those charts are from it. But his indicator LandryLight is included in ACP as part of your membership. So feel free to check it out. But it's a great way of just following long-term trends. And as he said, the way that I found it to be valuable is you bring up a chart, you quickly glance down, and you can identify the length of some of these trends because it's counting the days when the certain characteristics are in place. And when you get a reversal, like we're seeing with home builders, I jotted some of those tickers down, Pulte and Toll and others to dig into a little deeper. Thanks so much, Dave. We're going to continue on with our next segment called Sector Deep Dive. Occasionally, we like to look a little deeper at one particular sector, talk about some of the themes, some of the patterns to pay attention to. Today, we're going to dig into the technology sector. And the way we usually do this is using the industry summary page on StockCharts. If you've not seen that one before, go to Charts and Tools in the upper left. You'll see a big list of options. Click on Industry Summary. I usually use the table view. It breaks down each sector, and then we have a series of industry groups assigned to each sector. If we go down to technology, we can see the listing of groups within the technology space. There are 8 of them. I'm sorting them right now by the scooter ranking. You can click on the column, by the way, to resort it. So the StockCharts technical ranking, which we refer to often on the show, is basically a measure of trend. It has 3 components: long-term, medium-term, short-term. We have a chart school article that goes in detail how we calculate it. We give you all the details behind it so you can understand the methodology, but it's really just a quick way of comparing a group of things and order them in a meaningful way and focus on the things that are outperforming and underperforming and make sure that you allocate or that you are aware of those trends appropriately. We have different universes for different baskets. So we have a large cap group, a mid cap group, a small cap group, all US stocks. We have separate groups for stocks in London, stocks in India, stocks in Canada. And then finally, we break down ETFs in their own universe, and our 106 industry groups we rank as well. So this is a rank ordering of all the industry groups. We look at all the charts, rank all of their trends from strongest, which would be 99.9, to weakest, which would be 0.1. Let's go through this sector. And as you can see, by rank ordering them in order of trend, the number 1 group would be electronic equipment in terms of the overall trend of the industry. And then the weakest would be a group we call renewable energy equipment. This is kind of a tough one. It's solar stocks, hydrogen names, some things like that. They actually, people bucket them in different sectors. We've debated a lot. That's one of those groups. It's actually tough to figure out where solar goes because you can make an argument for a couple different sectors. Could be industrials, could be energy, even could be technology. We put them in the technology sector for our own purposes, but that's it. Now, this is just ranking the group, the industry. If you go within something like electronic equipment, you will see all of the stocks within that group and you can order them. So that top ranked group is called electronic equipment. It's a group that you're probably not super familiar with because there aren't a lot of large cap stocks in there. They're like Zebra, FLIR, FLIR. What else is in here that you might like? Trimble might be a name that you're familiar with. But a lot of these are names that you're probably less familiar with. It's not the mega cap names that you would think of. But if you look at it, some of the charts are actually fairly decent. You can tell by the fact that the group is ranked very, very well. Zebra Technologies is maybe one that you would be familiar with. This is in the large cap space, about a 27 billion market cap. And what strikes me with this chart, it reminds me a little bit of the chart of Apple if Apple improved a little bit from here. So it's sort of this really good run into February. And you can see the relative strength was very positive up until sort of mid to late February. From there, we've hit resistance. And I think the challenge with this chart is, can it overtake 520? Can it get above that resistance at the top? You can also see a support line down here. And really, we've traded between 460 and 520. And I think the easy thing about a chart like this, or the chart of Apple as well, is that at some point you break out of that range. We're not going to go sideways forever. At some point, we either break above 520 or we break below 460. I would be watching this chart to see which way that breaks and see which side takes controls. And anecdotally, we always say, do buyers or sellers take control? But it's really more about supply and demand, right? Is there more demand pushing price higher? Is there less demand or an influx of supply that would cause prices to go lower? So that is the number 1 group called electronic equipment. Again, I would look through some of those to see the names if you're not familiar with them. Now, the worst ranked group, if you rank them again in order, is renewable energy equipment. These are some names you may be familiar with. These are things like Plug Power, which is in the mid cap space, all the solar stocks, things like Enphase, which we've talked about. These are, I would describe as chart challenged. Plug Power is a good one to look at. At times, this was literally the top-ranked stock in our mid-cap space for months. I feel like it's really come back down to earth. Recently, was oversold there in early May, and the reason why I wanted to highlight this chart is it's really at a sweet spot. If you look at a trend line connecting the highs, you can see that we followed the trend line very well. We finally broke above it. And so overall, that indicates or suggests a downtrend that has reversed and gone higher. But now we're really at the moment of truth. We're testing the 200-day moving average from below. The RSI is right at 60. And if you've followed the show for a while, we often refer to that as the bear market or bearish phase range. In bear market phases, the stock tends to become oversold on downswings. On pullbacks to the upside, you rarely get above 60, right? That's sort of the line in the sand for a bearish chart. On the bullish characteristic, if you look at the second half of last year, you see the opposite. Plug Power became overbought on upswings and didn't get below RSI 40 on pullbacks. See how that has changed, and we're now in the bearish range. So my question is, can Plug Power get back above its 200-day moving average and get an RSI above 60? If so, I think that would complete a potential rotation back to more of a bullish trend. Support at 20 is very, very key here, I think, but given the severity of the oversold condition and the pullback into to the lows in May. But overall, potentially setting up more constructively, I would be watching to see what happens in the short term. Enphase and some of these other solar stocks are names that we've looked at. Again, overall, I think these are less attractive charts only because they've gone from an uptrend to a downtrend by any measure. Lower highs, lower lows, the RSI remaining in bearish range. That's what most of this group looks like. And until that changes, until you see signs of accumulation, meaning a higher low, meaning breaking above RSI 60 when the stock rallies, that would be more encouraging. Now, the rest of these groups are sort of mixed around in the middle. We only have about 30 seconds left. So I don't have much time to tell you. We've talked about the chart of Apple a number of times, and I would encourage you to review our recent discussions on that. If you missed it, Microsoft is one of those that, to be honest, it's not a bad chart. I mean, overall, the chart continues to appreciate. The challenge I have with Microsoft is that the relative strength just isn't there right now. We're testing a multi-month, maybe a 3 or 4 month relative low. It's testing its 50-day moving average where it sat for much of the last 7 or 8 months. It's sort of been trading around its 50-day moving average. We potentially put in a lower high here recently, and that's what I would be watching to see if we do pull back here, which I think we may. Do we hold 240, which would be the most recent swing low? If not, we're starting to see a change of character where lows are not holding and you have more supply than demand. And that's our deep dive in the technology sector. And again, touching on some of the key charts that we see in there, I would use the scooter rankings. If you want to understand a sector, dig deep into the groups and the individual stocks using the scooter ranking system. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P breadth by cap tiers. This is part of our Mindful Investor Live chart list. We review this every Friday as part of our normal Friday routine. But I did want to point out that as of yesterday's close, and I don't see this changing based on what happened on the markets today, all of the advanced decline lines that we follow have made a new all-time high this week. So overall, I'm always, at best, I'm a skeptical bull. At worst, I'm pretty negative because I think of technical analysis a lot in terms of risk management. But when I see charts like this with the advanced decline lines all going to new highs, you cannot be too negative right now, to be honest with you. You can be too negative. You can't be too positive, because of the fact that the trends are up, right? These advanced decline lines making new highs, telling you it's a broad advance and not to be too concerned. So that's chart number 1 for me. Chart number 2 is the technology sector. We dug into some of the charts within tech. And again, there's so many we could go through if we had more time. But, the chart of the XLK, I think, is at a really interesting point. For me, it's less about the price action, and it's holding trend line support using the recent lows, which the S&P is as well. I'm more concerned with the relative picture, and the relative strength has gone from accumulation to consolidation to distribution. I'm seeing this lower highs and lower lows. It looks like the relative strength of semiconductors until that changes. I'm concerned about tech being the opportunity here. I'd much more lean into the cyclicals. The reason why we have chart number 3 is for that reason as well. This is the ratio of high beta to low vol, making a new high again this week. If you look at where the high beta ETF is weighted, it's a lot of financials. It's over a third, 35, 36% or so probably in the financial sector. This is obviously going into the more value-oriented names right now, and that's why that group is doing well. It's telling me to continue to lean in to those cyclical sectors. Folks, that's our show for today. Special thank you to Dave Landry joining us from Louisiana today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.